to Morning Market Call. My name is Jeff Butler, and with me today I have Professor Brian Boyer. He is a finance professor here at the Merit School of Management, and we'd like to welcome him here today.
Thank you.
Today we're going to talk about options and maybe some of the misconceptions that the public has about options. I think a lot of people regard them as being highly risky. Some refer to them as a form of gambling, different things like that. So maybe my first question for you, Brian, is what exactly is an option, and how does it compare to something like a lottery ticket, for instance?
Great. Yeah, so an option basically is a contract that gives you the right to buy or sell an asset in the future. So for example, there are options on stocks. And a call option in particular gives you the right to buy that stock in the future at a specified price called the strike price. Mm-hmm. And the hope is that you enter into this contract, you pay a small fee, with the hope that when the time comes in the future, when the option expires, that the stock price is above the strike price, and you're able to buy the option at that lower strike price and thereby gain a profit.
Right.
Now, some options, the contract is set up so the strike price is very, very high. And so relative to the current stock price, there's not a very good chance that you're going to be able to exercise this option at a profit.
Right.
I refer to those options as out-of-the-money options. But however, there is some small chance that that the stock price will go above the strike price, and in that case, you essentially have won the lottery. Those kinds of options are very, very, very cheap because in most cases, you're not going to get anything out of them,
right.
Just like a lottery ticket. But if by some chance the stock price does explode, does jump above that strike price, the return that you get on your investment is like a lottery ticket.
I see. So who typically invests, or I guess tries out these type of options?
Yeah. So the usual wisdom is that it's people who are trying to hedge risk. In fact, back in the late 90s when LTCM went bust, this is a famous hedge fund that was doing a lot of some of these speculative investments. There were a lot of people in Congress that said, well, these option markets are just casinos for the rich. Why do they exist? Do they perform some sort of welfare function for the economy as a whole?
Right.
And Greenspan came to their defense and said, no, they're actually there to hedge and provide a way for some people to buy cheap insurance on different kinds of market movements.
Okay, very interesting. So, so if I'm not mistaken, you're currently writing a paper on options, specifically about how they're priced. Could you tell us a little bit more about that?
Sure. Yeah. So in this paper, we're finding evidence that people like to gamble in these markets, and that they have such an important influence on option prices that they actually move prices away from what we would usually think of them being in a usual economic framework.
Right.
So, for example, when you buy an asset, you think about the characteristics that you would consider when you buy an asset. First of all, you think about what's going to be the payoff I expect to get in the future. Mm-hmm. Of course, assets with higher payoffs in the future, you're going to pay higher prices for. But along with that, you should think about, well, how certain am I that I'm going to actually get that payoff?
Right.
And the usual thinking is that for portfolios that have lower uncertainty, given the payoff that you expect, you should be able to pay a higher price and therefore accept a lower return on average for that investment.
Right.
On the other hand, portfolios that have a lot of uncertainty around them, they should have lower prices and therefore earn very high average returns. Uh-huh. Now, so the thing that we're finding in this paper that's interesting is that after you control for that kind of risk, after you account for the risk these options are adding to standard portfolios, you find that options that look more like lottery tickets, they actually have very, very high prices and very, very negative returns, just like lottery tickets.
Right.
The thing that was so amazing for us is just the magnitude of these returns. So for options that are out of the money, if you buy a call option, you can on average expect to lose between -10% and -30% per week.
Wow, that's amazing. So you take that over a full year.
That's a lot of money, right?
Yeah,
That's
out of
huge.
control. That's crazy. So what are the important, I guess, implications of your findings for the market and maybe for the future of these types of options?
Well, the importance of this finding is that it helps us maybe think about the preferences of investors in a different way. Economists have known that people like to gamble. You know, people go to Vegas and they gamble. But the customary thinking is that there are enough reasonable people in the market that don't like such sorts of activities that they would arbitrage away the price effects of these other kinds of investors. In other words, they would bet against them and cause them to not have any influence on prices. But what we are finding is that, at least in option markets, where we see that provides a variety of lottery-like opportunities, that people who like to gamble are playing in these markets, and that they are important enough, they are big enough, that they are moving prices. And so it just helps us understand how investors are thinking about their investments, about risk, and you know, options are just one kind of market that offers a kind of lottery ticket. There are a variety of derivative type markets that offer these kinds of lotteries, and so our findings could be important in understanding how prices are set in these kinds of markets.
Right. Wow. So yeah, I think the findings of your paper and kind of what we talked about is really going to be important as any investor looks at the market, understanding that information and how prices can be moved by these, you know, so-called gambling investors, and then just kind of building that into their own investment strategies will be important, I'm sure.
Yeah.
Well, thank you so much for coming on the show today.
All right.
It's a pleasure to have you, and we invite you all to tune in next time on Morning Market Call.
Thanks.
Morning Market Call is brought to you by the Marriott School of Management in cooperation with the Brigham Young University Department of Communications. MMC is made possible by generous donations from Larry Tasjan and Gary Williams. This show was produced by Jeff Butler, David Wood, and Doug Mumford, with line producing by Beth Grimmett. For more information, please follow us on Twitter and Facebook.